G'day Aussies. Last year, many felt the housing market was unstoppable, record gains, booming suburbs, and the sense that property was a sure thing. But here's a truth most don't want to face. Your biggest asset can turn from a wealth engine into a liability faster than you expect. Interest rates have already jumped from 360% to 385% in February 2026. Household debt sits above 113% of GDP, mortgages are massive, and inflation is still stick-wage growth, barely keeping up. Ask yourself if rates climb further, or your suburb hits oversupply. Can you still service your mortgage without stress? Are you prepared for the hidden cracks in Australia's property boom? Interest rate whiplash is one of the most underestimated risks in Australia's property market. Many borrowers relaxed in 2025 when the RBA cut the cash rate to 360%. Variable repayments eased, confidence returned, and buyers stretched their borrowing capacity again. But February 2026 reminded everyone how fragile that comfort can be. A single 0.25% hike to 3.85% instantly changed the repayment math. Here's the principle: when debt levels are high, small rate movements have amplified effects. Australia's household debt sits above 113% of GDP. The average mortgage is roughly $350,000, and in Sydney or Melbourne it's far higher. On large loans, even a 0.25% increase can mean hundreds of dollars extra per month. 2 or 3 hikes, that's thousands per year. For households already managing rising grocery bills, insurance premiums, school fees, and energy costs, this isn't theoretical, it's cash flow pressure. The danger isn't just higher repayments, it's uncertainty. When borrowers don't know where rates are heading, confidence drops. Spending slows. Investors hesitate. Buyers pull back. Property markets, especially in highly leveraged suburbs, can cool quickly. And remember, inflation in Australia remains sticky. If it resurges, the RBA may prioritize price stability over mortgage relief. Rate cuts are not guaranteed. The solution isn't panic, it's preparation. Stress test your mortgage at 5.6% even if today's rate is lower. Build a repayment buffer of at least 3 to 6 months. Review whether your income growth genuinely supports your debt load. In a high-debt economy like Australia, interest rate volatility is not a side issue. It's the central risk. When leverage is elevated, stability becomes more valuable than optimism. One of the biggest misconceptions in Australia's property market is the idea of a national shortage. Yes, at a macro level, housing supply has lagged population growth, but property is not a national market, it's thousands of micro markets. And some of them are quietly oversupplied. In 2025, strong migration and rate cuts lifted prices broadly. But beneath the surface, certain apartment corridors in Brisbane, Melbourne, and parts of Sydney saw rising listings and slower absorption rates. Greenfield estates on city fringes expanded rapidly. Developers responded to demand signals from 2024, and supply is now catching up. Here's the principle: price growth depends on scarcity, not headlines. When too many similar properties compete for the same buyer pool, prices stagnate. Investors often overlook this because national data looks healthy, but oversupply works locally. If buyers have options, they negotiate harder. Days on market stretch. Discounts increase. Rents can flatten if vacancy rates rise. Apartments are particularly sensitive. Unlike established houses in tightly held suburbs, new builds can be replicated quickly. If credit conditions tighten, especially with new PFDI caps limiting high leverage loans, marginal buyers disappear first. That's when oversupplied pockets feel pressure. This doesn't mean property is collapsing. It means location and asset quality matter more than ever. Before buying, study vacancy rates, building approvals, infrastructure plans, and population trends in that specific suburb, not just state-level growth figures. Avoid areas where cranes dominate the skyline without corresponding long-term demand drivers. In Australian property, broad optimism can hide local risk. The difference between a resilient asset and a stagnant one often comes down to supply discipline. Scarcity protects value. Oversupply quietly erodes it. Debt built modern Australian wealth. Without leverage, few households could afford property in Sydney, Melbourne, or even mid-sized regional hubs. Borrowing allowed everyday Australians to control high-value assets with relatively small deposits. Over decades, rising prices amplified returns. But here's the principle: leverage magnifies outcomes, both gains and losses. When prices rise 8–10%, leverage owners benefit disproportionately. A $900,000 home bought with a $150,000 deposit can generate strong equity growth in a boom year. That's the attractive side of debt. The other side appears when conditions tighten. Australia's household debt is already elevated, above 113% of GDP. Loan sizes are large relative to incomes. Now, with APRA's new DTI caps limiting high debt lending, credit growth is becoming more constrained. That matters because property prices don't just rise on demand, they rise on available credit. If borrowing capacity shrinks, buyer power shrinks. And in a credit-driven market like Australia's, that can cool prices quickly. For individual households, high leverage increases vulnerability. A job disruption, illness, or rate increase becomes more dangerous when debt servicing consumes a large portion of income. Financial flexibility disappears. Decision-making becomes reactive rather than strategic. Debt itself isn't the enemy. Poorly managed debt is. The key question isn't, how much can I borrow? It's, how much can I comfortably sustain through a downturn? In strong markets, leverage feels smart. In volatile environments, it demands discipline. Used carefully, debt accelerates wealth. Used aggressively, it reduces resilience. And in a high debt economy like Australia's, resilience is becoming more valuable than maximum leverage. Australia, property headlines often focus on record price growth, the six-figure gains in Sydney, Melbourne, or Brisbane. But relying solely on capital appreciation is risky. True financial security comes from cash flow, the money flowing in versus the money flowing out. Here's the principle: even the most expensive property can become a liability if it doesn't generate sustainable cash flow. Consider the average Australian mortgage today, around $330,000 to $350,000 with variable rates rising. Add insurance, council rates, utilities, and maintenance costs, and the monthly outgoings can quickly exceed rental income, or what your wage comfortably supports. If interest rates rise further, negative cash flow accelerates stress, regardless of whether the property continues to rise in value. Many Australians buy for capital gain alone, assuming that future price increases will cover current cash shortfalls. That's dangerous thinking. Markets are cyclical, booms end, rates rise, and rental yields often lag property growth. A property that looked like a wealth generator in 2025 can become a financial drain in 26 if cash flow isn't properly managed. Cash flow discipline also protects you from emotional investing. When repayments are manageable, owners can hold through temporary downturns instead of panic selling. It gives flexibility, the ability to refinance, invest elsewhere, or ride out a market correction. For everyday Australians, the takeaway is simple: always focus first on whether your property covers itself comfortably. Capital growth is a bonus, flow is your safety net. In short, the house isn't just an asset, it's a commitment. Treat it as a business investment, not a lottery ticket. Let cash flow guide decisions, not hype. Because in Australia, financial resilience isn't built on yesterday's gains. It's sustained by the money that keeps coming in month after month. Australia's property market is famous for its boom and bust rhythm. Prices surge, sentiment soars, and optimism dominates headlines. Then, inevitably, conditions tighten. Interest rates rise, credit contracts, or oversupply emerges, and growth slows or reverses. The principle is simple: cycles repeat, and ignoring them is costly. Over the past 30 years, Sydney and Melbourne alone have seen multiple boom-bust sequences. In the 1990s, rates peaked above 17%, halting growth and forcing many households into stress. The 2000s saw another surge, followed by a global financial shock. More recently, 2020-2021 pandemic-driven cuts and stimulus led to record gains, only for 2025's boom to invite a February 26 rate hike. History shows that no market climbs indefinitely. Understanding cycles matters for both buyers and holders. Those who enter at the peak, overly leveraged or unprepared for rising rates, risk negative equity or forced sales. Conversely, those who plan for downturns, by holding quality assets, maintaining buffers, and avoiding excessive debt, benefit from long-term growth. Cycles aren't random. They are shaped by predictable forces: interest rates, supply-demand imbalances, credit availability, and broader economic conditions. Recognizing these patterns allows Australians to avoid reactive decisions driven by emotion or hype. For everyday homeowners and investors, the lesson is clear. Don't confuse temporary optimism with permanent safety. Evaluate your property in the context of long-term cycles, not short-term headlines. In Australia, wealth isn't created by chasing the top of the market. It's preserved by respecting the rhythm of cycles, preparing for inevitable corrections, and making measured, principle-based choices. Ignoring the lessons of past cycles leaves households exposed to risks they could have anticipated. Those who act with foresight ride cycles instead of being broken by them. In Australia, it's easy to get caught up in short-term excitement, surging prices, hot suburbs, or the latest rate cut headlines. But real wealth isn't built in months, it's shaped over decades through disciplined, long-term positioning. The principle is simple. Focus on resilience, not speculation. Property remains Australia's most reliable wealth engine, but only when approached strategically. Buying a home or investment property in a supply-constrained, established suburb with strong rental demand is far safer than chasing the latest hype in fringe developments. Diversifying across locations and asset types reduces vulnerability to local shocks, oversupply, rate rises, or regional economic weakness. Long-term positioning also means preparing for uncertainty. Build buffers for rate rises, keep debt manageable, and avoid over-leveraging in a high-interest environment. Even if the market pauses or dips, a well-positioned household can weather the storm without panic selling. In contrast, chasing short-term gains often leads to reactive decisions that erode wealth. Superannuation is another pillar of long-term strategy. Australians who start early and contribute consistently benefit from decades of compounding, insulating them from short-term volatility in property or equities. Similarly, cash flow management ensures your holdings are sustainable over time, reinforcing resilience. Unexpected shocks, cycles, rates, and economic conditions will always fluctuate. The difference between investors who prosper and those who struggle is preparation. Long-term positioning isn't glamorous, but it's effective. In short, don't be distracted by short-term noise. Wealth in Australia isn't made by timing the top of the market. It's protected by strategic choices, diversification, and disciplined planning. Buy wisely, manage debt, and hold quality assets. Memorable closing line. In Australia, fortune favors the patient, but resilience protects the prudent. Property remains Australia's most powerful wealth engine, but only if approached with discipline, perspective, and preparation. Speculation might feel thrilling in the short term, but wealth here isn't made in the boom, it's protected in the downturn. Remember, testing your assumptions is worth more than chasing yesterday's gains.